So thank you to those for joining us for our session today. This is one in a series of what we're calling sprints, our sprint series to help recruiters grow their businesses and add value to them. And we're delighted today to have Andrew Casson with us. Welcome, Andrew.
Thank you, Damien.
Andrew is in the game of mergers and acquisitions in the recruitment industry, and he's been doing it for some time now, and has written books. In fact, I think we've got an offer later in the webinar about how people can access a copy of that book for free. So stay tuned for that one. Let's kick off. Andrew, welcome. What should agency owners be aware of around the reality of selling their business when they get to that stage? That's probably my first question.
It's a good one to start with. Good morning, everyone, and Damien and Encore. Very, very glad to be here. It's always an honour to be invited to speak at other people's webinars or on podcasts, if I like. Yeah, pretty topical. Starting to see a bit of activity in the space now, and it's been pretty quiet for the last 18 months as recruiters have just really been trying to figure out what happens next week rather than looking too far ahead of that. So, but I'm starting to get some calls again now. So the whole concept or the whole reality of M&A, mergers and acquisitions, and valuation is starting to become hot again. So if you're a business owner in the recruitment space, one of the things you'll need to think about, or you need to be aware of, is it does take time. Over the last 20 years of doing this, there have been quite a lot of business owners who've come to me when they're already ready to move away. So they've made the decision, they're 1 foot out the door, they come to me and say, okay, I want to sell my business now. And I tell them it's going to take 6 to 12 months, and they freak out a little bit because they don't think they can hang on that long. They've already made the decision to get out. And what invariably happens at that stage is their business isn't very well prepared and isn't as appealing as it could be if they actually were able to put some time into it. So, yeah, I think if you're a business owner and you're thinking about selling at some stage, just be aware that it is going to take 6 to 12 months from the day you pull the trigger and engage an intermediary like myself to actually get a completion. And there also might be retention periods after that. We'll cover that later on. Another thing to be aware of is that there can be a difference between what it's worth, and I'll talk about that in just a moment, and what it's actually going to sell for. And the reason I make that distinction is accountants are very, very good at doing valuations based on certain methods. But unless they're an industry expert and they have comparable sales and actually know the buyers and what's happening in the market at that point in time, those valuations can be well above what is actually realisable. So it's really important when you're thinking of preparing a business for sale to be mindful of what the market is actually going to pay for it, not what you think it's worth or what your accountant thinks it's worth, but what the buyer's actually going to think it's worth. And on buyers, I mean, they're primarily interested in sustainability. They really are not that fussed about the blood, sweat and tears you put into the business over the years. They're not really too concerned about all the things that keep you awake at night. They're only interested in what does the business look like day one after they own it, and then at the end of the first week, first month, first year. How sustainable is the business? And so all of their valuation, all of their analysis of the business is going to be around how sustainable that is, particularly after the owner has left the building for the last time. And I think finally, for business owners, from a very, very large proportion of business owners, their business is their most valuable asset. I know real estate prices have gone through the roof recently, so that might be shifting a little bit, but generally business owners have built a business and it is their most valuable asset. And selling an asset, or like a business, is not like selling a CV. It's not like selling a candidate to a client or selling a job to a candidate. It's a very complex and very difficult process, and it's full of potential pitfalls and potholes along the way. And so it's really, really critical that you start building an advisory team sooner rather than later, and make sure you're surrounding yourself with good people who've been through it all before. You would think after 20 years that I would have seen everything that there could be to see in the M&A space, but it's almost every time that a new transaction is going through its paces that something else pops up you haven't come across before. And you don't want to be trying to sell it yourself for the first time and experiencing the same things. You'll never get it done, and you'll lose a lot of money along the way.
There was two things you said there, Andrew, which are interesting. One was sustainable. So when you say sustainable, what do you mean by that? What are the things that can contribute to being a sustainable business? And then the other one was in relation to 6 to 12 months.
Yep.
Let's just address 6 to 12 months first.
Yep.
What goes into that? Why does it take so long?
Okay, well, there's various stages that a sale process goes through, and the first thing you're going to do is the preparation stage, and that's when all the relevant transaction documentation is being prepared. The information memorandum, which is effectively the marketing document, the resume for the business. That can take, depending on how quickly information is made available, it can take about a month to get that right through drafting and design until it's ready for final approval. Writing up the teaser that goes out if you're approaching people using a teaser, getting the data room. The data room is now used to be actually a physical facility. And I remember when I was in a recruitment company in the mid-90s, there was an office that was basically had a locked door all the time. And only certain people were going in and out of that office. And that's where all the data was. That's all the documents. And so the buyer's team was going in there to actually just trawl through reams and reams of paper. These days, data rooms are online. They're virtual data rooms, as they're called, and they use, they're hosted by companies like Intralinks or Ansarada, Firmex, those types of businesses. You may have heard some of those. And the information that is uploaded into those data rooms has to be verified and validated and coded, and it has to be trackable. And there's just a lot of administration that goes in. So that preparation phase to actually get all of that transaction documentation ready, and there might be some other bits and pieces that go into that, can be 1 to 2 months. And then you actually have to do the outreach to the buyers that you've identified, because you have to go through the process of profiling the ideal, the buyer avatar, as it were, and come up with a short list of companies you're going to approach. Particularly in the recruitment space, it's really dangerous to let the whole market know that you're on the market for sales. It has to be a very discreet process. And so we like to keep it very targeted to specific buyers. And so we have to go through the process of coming up with a short list of potential targets. And then we have to go out to those targets, and depending on their internal machinations and how long they take, it can take 2, 3, 4 months to even get through that first phase, depending on how many layers of approvals there are. I always like dealing with private buyers, like private company buyers, because it's generally the person who you're talking to is the one who makes the decision at the end of the day. Public companies can have M&A teams, they have C-suite, they have boards, they have to convince. Offshore buyers are the same. So yeah, it's going to take some time. And then once you've actually entered into an agreement, a heads of agreement with one of those buyers, you accepted an offer, then you've got due diligence and contract negotiations. And again, depending on who it is that's doing what's on the other side of the table, it's going to take 4 to 6 weeks, or it's going to take 6 months to get through that process as well. People often ask how long a process is going to take, and my glib response is sometimes, how long is a piece of string? You just don't know.
Yeah.
So you can provide some guidance, but really, you just have to be aware that it's going to take some time.
And with the comment around sustainable, what are recruitment agencies typically valued at? What drives the valuations? And if they do vary, why do they vary so much? And I'll just throw another one in there. Is there a nature of things being cyclical as well? So I know that there's some global themes out of the US at the moment where the whole talent industry is on a global push in particular sectors. does that drive the valuations as well? So how are they valued? What drives them? And is there any kind of cyclical nature to that as well?
Okay, so there's a bit of that question, so I'll try and go one by one. Anybody who has been involved in the recruitment industry for a long enough time will tell you that most transactions are going to be valued at about 2.5 to 4 times an earnings figure, usually earnings before interest and tax, depreciation, amortization, EBITDA, or just EBIT. There's not a lot of capital, it's not a capital intensive industry in recruitment, so it tends to be EBIT or EBITDA, about the same. So it's generally 2.5 to 4 times. And if it's a labour hire company or a company with a big contractor book, the validation metric on that could be 1 times GP or 1 to 1.5 times GP or net determinable revenue, whatever the metric is. So if you've got a business that's making $500,000 in EBIT and it's doing $1.5 million in GP, it's probably worth about $1.5 million, just as a rule of thumb. The reason it fluctuates is back to that question of sustainability. So, if you've got a company that's deemed to be less sustainable, it's going to be down the bottom end of that range at around 2.5 times, maybe even less. It could be 2 times. It could be worth nothing. I'll talk about that in a moment too. But a business that's got a good management structure, that's not dependent on its owner. If the owner was to leave, then the impact on the business would be negligible. Then it's more likely to attract a higher multiple. Now I'm doing some offshore, or an offshore transaction at the moment, and the multiples that we're talking about there are considerably higher. So yeah, it really depends again on who the buyer is and what they're looking for. But that's a $150 million revenue business. So it's got scale, it's got a management structure, it's got systems, it's got everything it needs, to keep on going post sale without missing a beat. And I said I mentioned before, business could be worth 0. So if you've got a permanent recruitment business only, it's probably worth close to 0. And that could be a bit of a kick in the guts to some people who are listening, thinking that they don't really want to do contracting or temps or anything like that. But buyers want sustainable revenue. They want annuity revenue. So they want to know that day one and week 1, month 1, there's a certain amount of revenue that they can depend on still going. And that's why it's really important to have annuity income streams. Perm recruitment is fantastic for cash flow and profit when you own the business, but when you go to sell it, it's just not appealing. If you're an executive search, it can be, but generally, it's just not seen as overly attractive to buyers. So, what was the other parts of the question?
One was
what drives value.
Yeah, what drives the value? So I think you've answered some of that.
You mentioned
the annuity and the recurring income, the management team, the sustainability of the earnings.
But the market does drive it as well. So you did mention it's the cyclical nature of it. And sometimes the recruitment space is in vogue and sometimes it's not. We often say that the recruitment industry is the canary in the coal mine when it comes to public markets. If jobs, or if hiring starts slowing down, recruitment industries start getting hit, then there's probably trouble brewing on the economic horizon. So they can fall out of favour pretty quickly. But supply and demand can drive prices just like any economy. So if there's fewer good assets on the market, they're probably going to get higher prices or higher multiples than in times when there's abundance of opportunities in the marketplace. And buyers have their pick. So buyer's market or seller's market. It's obviously better to be in a seller's market. The strategic value to the buyer is really important as well. And that's why we're always trying to target strategic buyers, because if you've got a business that's very, very strong in a certain niche, and that could be in its sector, it could be in its geography, it could be in its brand, there's a whole range of reasons why it could be. But if that could then be appealing or really, it can fill a strategic gap for a buyer, for the other organisation, For example, if you've got an IT recruitment company and you're in Melbourne and you specialise in digital, okay, but you're not in any other state, a business that's in Sydney and Brisbane and maybe New Zealand but isn't in Melbourne might say, fantastic, we actually want a business that is in Melbourne to complete our network. Our strategy says we want to be in Melbourne, but it's actually going to be more efficient for us to buy something there. So that's what we're going to buy. And they'll pay a premium for that because there's a lot of benefit to the organisation to have a national, or what they would consider, you know, the right footprint for their organisation. I guess finally, the price earnings ratios in public markets also drive acquisition prices. So, you know, Talent 2 is one of those companies that was valued at more than 20 times PE, with a PE of 20 plus. And it could then afford to pay a lot more for acquisitions. It could pay 7 or 8 times net profit after tax. Whereas its competitors who are trading at 12 or 13 times on the ASX couldn't only afford to pay 4 or 5 times net profit after tax. So the higher the PE ratio, and that really depends on how appealing the sector is for investors to get into, can also drive how much they're prepared to pay for acquisitions, because public companies need to keep growing in order to keep their share price buoyant and growing to give the investors the returns they want. It's a funny game.
Yeah, yeah. And who are the typical buyers? So if you're an organisation here in Australia and one of our clients, and we talked about niche and geography and perm versus contract and those things, who's a typical buyer that would buy? Well,
typically it's your larger privately owned companies, and they'll buy something that's about 30% of their size, typically, is a good benchmark. So if you've got a business that's doing 100 million in revenue, its appetite for an acquisition would be something around the 30 million revenue mark, or thereabouts. ASX, the listed companies, so People Infrastructure has been a really good example of this over the last few years. It's been buying up companies left, right and centre. They're very, very active. And there are still a few listed companies, but you know, historically it was the skills, the programs, you know, Candle as it was, which is not anymore, it's Ignite. It was, who else was busy? Obviously Talent 2 was pretty busy. Channel McLeod, they made quite a few acquisitions. So those businesses that were very, very active once upon a time aren't anymore. You know, Ignite's fortunes have certainly changed, and others have been bought out, so they're not active as buyers anymore. And the problem also with those companies, when they get to a certain size, again, they have to make bigger acquisitions, and there becomes a lack of them in the marketplace for them to buy. It's just nothing available. Then you've got the offshore buyers. You know, so I'm dealing with companies in Japan at the moment. They're sitting on bucket loads of cash, which is earning 0 interest in the bank at the moment. So they've got all this money. They need to deploy it, and even if they can get a 10% return by deploying it through an offshore acquisition, that's better than it sitting on, you know, just sitting in the bank earning nothing. And it also allows them, this is a good time for them to be deploying that capital and growing a global footprint, making themselves more appealing and more valuable to the market. You've got private equity and family offices and, you know, private investors who can buy. They're looking for sustainable revenue, sustainable return on investment, really. They don't tend to pay quite as much as strategic buyers, but they're all cashed up. I mean, private equity is sitting on $13 billion in dry powder at the moment in Australia. It's a lot of money that needs to find a home. So if you've got a business that is prepared well enough and can be appealing to private equity, then you've got a ready-made market of companies that will start fighting over you just to win the right to give you the check. And then there's the internal buyers. There's your management buyouts, or even selling to staff through the employee share ownership program structure. So there's a whole range of people, and they're sort of the typical buyer, or the best buyer for the perm businesses that I was talking about earlier. Is your senior people in a perm business are probably best placed to buy out the owner over a period of time, because they know and understand the business, and they aren't going to put as much risk profile on it, because they're the ones who are probably driving the performance of the business.
In that situation, Andrew, just to you offer a corporate advisory service to enable that to happen.
Yeah.
Okay, good, good. I know you've done transactions from 500,000 through to 25 million. Now, what kind of level do people need to be at to get some sort of interest? I mean, what's too small, I guess, is the question from a sustainable earnings perspective.
Well, it tends to be the businesses that are smaller aren't as sustainable. So, if the business is worth 500,000, it's pretty likely that it's going to be overly dependent on its owner for revenue generation, for leadership, for client relationships, for billing. So that's not ideal. So you tend to get better businesses, better propositions when they're doing $1 million plus in EBIT. So they're likely to have more than 10 staff at that point. They've probably got a management structure of some description. The really appealing ones, and the ones particularly if you're going to get the interest of private equity or offshore buyers, you're doing 2 million or 3 million in EBIT. So you start to build some scale. For me, I'm really looking at the sweet spot being that 20 to 50 staff.
Yep. Okay. Sorry, I was just doing some quick numbers.
That's all right.
No, I was just trying to equate, if you had 100 contractors out at 250,000, that's 25 million at 20%, which I think is about 5 million. So
5 million DP.
Yeah, so that's getting up there, right?
Absolutely. That's a good size.
Yeah. So yeah, just trying to understand what some benchmarks might be for people to aspire to, so that then there is a value placed on their business. So why
it's interesting. Sorry, you were just talking about
on.
contractors there. I think it's interesting to also understand what an industry norm is, or a rule of thumb when it comes to preparing for sale. I've just seen one of the questions pop up about what they should do to position themselves for the future.
Yeah.
But one of the rules of thumb in the recruitment industry is your net margin or your GP from your contractors should cover your below the line costs. So it tends to be about 80% or so of your net revenue is coming from contractors at that point, and then all your profit is coming from your perms. That's a pretty good aspiration. It's a good model. It's the basic 80-20 rule. So yeah, that's probably a good benchmark to aspire to.
Yep. What are some of the things that owners can do now? You talked about that 6 to 12 month period. Even if the sale's not on the horizon, even if they're just starting out, what are some of the things that they could start to work on in their businesses, so that when the time comes, they're ready?
Yeah, well, there's 3 what I would consider big rocks for recruitment agencies in particular. The first one is principal dependence, and that is the extent to which the business is reliant on its owners for the way the business performs. Michael Gerber, who wrote The E-Myth, is famous for saying work on the business, not in the business. And it's really good advice to follow for anyone who wants to grow a business to the point that they can sell it, is actually build a management structure and build the consulting capability so that you don't have to generate a cent of revenue yourself. I mean, it's all well and good to be a rainmaker, like a partner in a professional services firm, and have client relationships and bring work in. But the moment you start billing and actually doing assignments, you're actually devaluing the business a little bit and making it very, very hard to walk away from. You really should be able to answer the question, if you were to leave the business for 3 months, what sort of position would it be in when you got back? If it's in a better shape when you get back, that you've definitely got a saleable business at that point. If it's about to close its doors, then it's too reliant on you as the business owner. The second big rock is probably around clients. Again, the 80-20 rule. You shouldn't have more than 80% of your revenue coming from 20% of your clients. You shouldn't have any one client representing more than 20% of your revenue. You've got to have a good spread.
Good spread.
Ideally there's not one client that's representing more than 10% of your revenue. And the reason that's important is that if you were to lose that client, if by virtue of going through a sale process, a client decided that they didn't want to continue doing business with your firm, and they decided to go elsewhere, then the value in the business isn't going to be materially affected. But if you're reliant too much on one client, then that's a problem. And a buyer will know that. So they get very, very scared of client concentration issues. And the third big rock is systemization. So making sure that you have systems for everything, and not a paper-based manual, employee manual or anything like that. The actual workflow is automated. Email, so what do you call it? EDMs, your SEO. You've got processes in place for recruitment, retention, remuneration, performance management, everything. So basically, if everybody was to leave on day one and the buyer had to replace every member of staff, they could come in and within a few weeks' time be up and running again, because you've captured all that knowledge, you've got processes for everything. And I guess the final thing there is know who you're going to sell to, because selling a business is much like selling any financial asset or any investment. You've got to know who your buyer is going to be. So if you wanted to sell to private equity, for example, or be appealing to private equity, you'd need to structure your business so that the investor would be able to generate their target, which is an internal rate of return of 30%. If you can't show that proposition, you won't get anyone coming to the table. Or you might say, we want to be really attractive to a Japanese-based company. And you come to me and say, what are they looking for? So I'll give you a list and say, okay, over the next 2 to 3 years, you need to get to this size, you need to have this sort of structure, you need to be in these niches, go forth and prosper. That's what you need to do. So really pick your target. Identify your avatar early on and orient your business for that. It's not, I guess as a business owner, when you say working on the business, not in the business, by working on the business, you're actually saying my business is the product now. It's not what we're selling. That's not the product anymore. It's what I'm creating is the product. Who's going to buy it?
And in your experience, Andrew, some of the transactions that you have done, and I'm, some of those that have started, because most of our clients that we deal with have been in business for less than 5 years, some longer, some are 10 and 15, of course. Now, what are some of the traits that they've done in their first few years to get to that level? What are some of the things that they have done? I know you've run through a list of things, but is there any standouts or a case study or an example that you can use without disclosing who it was?
Yeah, I can think of one. There was one that I dealt with that was bought by a private equity-backed company out of London. That was a very, very large transaction, but it was a large player in the same space here in Australia, and it was actually quite easy to do because, for the UK-based company, it was like, well, we can basically buy a little brother. It's the same as us, but in another market. It makes absolute sense to do that. So that was really an example of positioning a business so that it's really appealing to a particular type of buyer. But there's so many transactions over the time. There's very few that have really common traits. Look, anything is saleable at the right price at the end of the day. Like maybe unless it's completely home-based, it's a real struggle. But most businesses are saleable, even if they're small. I've had one business that was basically one temp consultant and a bunch of temps. They had a brand that had been around a while, but we transacted that in 5 weeks and got the business owner what she wanted for the business, which wasn't much, but it's what she wanted, and she got the outcome she wanted. She was happy with that, and the buyer got something they were very happy with as well. So, it's really hard to say exactly what the common traits are. I think probably being realistic about the market, because where a lot of deals fall over is when the vendor's expectations and the owner's expectations in terms of price and terms aren't met by the market. And so someone has told them that, and it could be, Mr. Blogs down the street who sold their company or took it public and got $40 million for it.
Yeah.
Who's had a word in there and said, "Oh, you got a business? Oh, that's great. It probably should be worth about $40 million." And so the business owner comes along and says, "I've got a business that's worth $40 million." You look and say, "No, it's worth about 400,000." And then that's where things are you're never going to be able to bridge that gap in expectations. I actually had one a few years ago in the recruitment space. I won't mention the sector because it's too easy to identify, but that was a situation we found ourselves in. Got all the way through to almost completing the transaction, and the owner walked away from the deal because her trusted advisor said that she should be getting 7 times EBIT for her business, and the industry or the market was offering 3.5. And there's no way she was ever going to get 7, but she believed this person that that's what she should be getting. So I think the real common trait is just having realistic expectations about what it's going to sell for. As I said, there's a distinction between what it's worth and what it's going to sell for.
Yep. We've got a question there from Reece Richardson, which is, and I think we've addressed a lot of it, but we've just started out, or about 5 to 6 months in, purely focused on billing. Is there any specific advice or suggestions on what they should be doing or focusing on at the moment in time to make sure that the business is positioned for the best value in the future? And I know we mentioned perm versus annuity, management team, all those things. Is there anything else that you could add to that? Niche versus geography?
Again, having a clear view of who you're going to sell to and what your value proposition is going to be at that point. So if you're in a certain sector, be the best in that sector. Own it. Know everyone. Don't start trying to branch out into other sectors. I had a situation.
Specialised, is that probably the term?
Sorry?
Hyper specialised in a particular sector. Yeah,
absolutely. I had a client a few years ago who came to me and said, "Oh, we've got an IT division, we've got this division, we've got this division." And the reality was they had one person on a desk in their IT division. So that's really, you can't do much there. You've got talent international out there who's got hundreds of people who are doing IT. It's not really worth it. You're better off being inch wide, mile deep in a particular niche and just be brilliant at it. And that's where you'll be most valuable to someone, because competitors will come and try and buy you out, or will want to buy you out because they can't get in because you've made the barrier to entry so high. It's impossible to dislodge you. That's really where the value is.
I think one of the industry icons, Jeff Slade, said that, didn't he, in the early 2000s? Get big, get small, or get out. And
that sounds like Jeff.
Yeah, and it was an inch wide and a mile deep, as opposed to being a mile wide and an inch deep.
Exactly.
Really.
There's no value in being a mile wide, inch deep.
Yeah.
You can't be all things to all people.
Yeah.
You've got to be brilliant to some people.
Yeah. Sure, if you've got any other questions? I know we've got about 9 minutes left. So
we're going to talk about why companies would buy rather than go organic.
Go organic, yeah.
And I think we've covered off some of that as well.
Yeah.
But why do people buy? It's typically a quicker way for them to achieve critical mass. And there's been so many horror stories of companies that have been based in Sydney and been really successful, and they say, "Oh, we should get into Melbourne." And so they send one of their key people down to Melbourne, and they don't understand that the market operates differently down there, and it dies. They throw good money after bad for months on end and finally write it off, or vice versa. People coming out of the Melbourne market and the way Melbourne operates, trying to come to Sydney, it's very, very different. And there's just there's a litany of tragedy when it comes to people trying to do that. So it's a faster and less risky way. It's more expensive, but it's certainly a less risky way of getting into a market that you're not currently in. And a lot of buyers will do that. Public companies buy because they need to. They need to keep showing growth. If they're not growing, they're going backwards. And the share price will reflect that. I mentioned the Japanese buyers earlier, sitting on mountains of cash. They need to deploy it to get a return on investment that's better than being in the bank. And they also need to make themselves more appealing to their shareholders as well. So there's a range of reasons, but generally because it's a less risky and faster way of getting into a market they're not currently in, which is why people buy.
I've got a question for you from the great Phil Mulvey. Graham, who one of our very valued staff members. What is your opinion about government PSAs, in or out? I know that they give you an annuity on income.
It's so funny you mentioned. I had a call from a client yesterday, and he said, "Oh, we've just been invited to be on a state government panel. Should we do it?" And we went through a bit of Q&A on that. And I said, "What's the margin?" He said, "Oh, 5%." I said, "Don't do it." It's actually pointless doing that, because all you're doing is growing your top line. But overall, it's actually, and that's if you end up placing people, which I'm not even sure you make money on, because at 5%, I'm not sure how you're even be able to afford to service that client with any skill. But it'll actually drag your overall gross profit margin down. And their business was sitting at between 16 and 20%. So if they were successful in government, then they could see their average gross margin drop to 10%. And that would be pretty disastrous, really, in terms of its appeal to potential buyers. So they're off not doing that in that case. There was a situation a few years ago when a large company was trying to, as the owner told me, get the set. They were on every government panel except for one, and they were busily knocking on every single door of every agency that was on that panel so that they could get the set and be on every state government panel. That sounds like a vanity purchase to me. It doesn't really sound like there's any real strategic thought about why they'd be doing that, because they're losing money on those sorts of transactions. But anyway, I think those days are behind us. Most business owners or buyers are a little bit more astute when they're evaluating their metrics now.
Interesting. We've got a question from Danny Graham. Now, Noam, are you able to switch Danny's microphone on? I'm not too sure how that works. Well, Danny, can you switch yours on?
Yeah, I think is that working?
It is indeed.
Oh, very good. Yeah, I had two questions. One just regarding, I guess, the cost of selling your business. Obviously, a 6 to 12 month process would have, I assume, legal fees, advisory fees, that sort of thing. Is there any sort of standard way to estimate how much that would cost?
Well, there's going to be 3 advisors that you should be hiring. And you really should have an intermediary, because, as I pointed out earlier, there's a lot of potential pitfalls through the whole process. It's quite complex. So you've got your intermediary, your lawyer, and your accountant. Now, depending on the structure of the deal, whether it's a share sale or an asset sale, I haven't talked about that, but we probably don't have time to go through that in detail. But there's 2 types of transactions. One, the buyer buys the entity, and the other is they buy the assets of the business and then transfer those to a new entity. If it's a share sale, your legal costs are going to be much higher because the contracts are far more complex. If it's an asset sale, the legal costs will be lower. But from a budgeting perspective, generally what I experience is, I guess the average legal bill is going to be about 20,000, and that can obviously go up or down depending on the nature of the transaction. Your accountant, because they should be advising you through the process, probably budget for about 10, and then your net outlay on your intermediary is probably going to be around 5%. But it depends on how big the transaction is. If it's a much larger transaction, the percentage will be lower typically. Or you can cap the fees at a certain level as well.
And can you negotiate in the acquirer can take some of those fees as well?
No, you can't play both sides of the fence. You need to have your own advisors to avoid any potential conflicts of interest. In some markets, it's actually normal for a party like an intermediary to play both sides of the fence, but not in Australia. It's actually our licensing doesn't allow it anyway.
And Danny,
our job is to get a higher price, so we pay for ourselves. Sorry, Danny, you had another question?
Yes. Obviously, Encore provide an outsourced finance and payroll solution to companies like ourselves. And as part of that, there's a service fee that we pay to that. Presumably, if we sold to a larger recruitment agency, they may have that capability themselves. Would the valuation of the company factor in the fact that if they had that finance capability themselves that they would no longer need that?
Absolutely, yeah. So we go through a process of normalisation
Okay.
on financials, and so anything that's non-business related in terms of expenditure gets normalised out at monthly. That could be salaries that owners are drawing that are above market, or rent that's above market gets factored back in. But one of the key things is we talked about EBIT before as the metric that we assign a multiple to. It's earnings before interest and taxes, basically your cost of capital. So we always add back your bank fees, your facility fees, interest paid, all those types of fees, because as you point out, the buyer is likely to have their own facility and their own capital base.
There's no need to sort of remove ourselves from that cash flow facility to make a better valuation for sale or anything like that.
No, I mean, to be honest, you probably should be making the most of it to grow and fund the business's growth over that period of time. So because it's not going to impact the sale value.
Cool.
I wasn't saying that just to make Damien happy either. I think it's
No, and look, I'm probably a bit more simplistic than that. That when you do divest the business, it's easy to turn off. You don't have all the hassles of migrating staff and systems and finance facilities off. So, very, very good point. Wonderful. Thank you, everyone. Short and sharp. Some good questions asked there. Noam sent through the link to Andrew's profile on LinkedIn, so feel free to reach out. Get your free copy before Christmas, and thank you everybody for your attendance and your questions, and thank you most importantly to Andrew. Really appreciate you giving your time up today.
Oh, it's an absolute pleasure. Thanks so much, Damien. Really appreciate it.
Wonderful. Thanks everyone.